This is the first in a series of resources that consider the journal entries needed for various basic transactions. Part 1 introduces the general journal as an alternate method for bookkeeping. We then consider the journal entries needed for acquiring cash and other assets. Part 2 looks at the journal entries for selling goods. Part 3 focuses on the journal entries for collecting cash and paying other obligations. In a previous resource, we learned how T-tables make accounting more straightforward by eliminating pluses and minuses in each asset, liability, and owner's equity account for a business. However, this leads to many T-tables. For the day-to-day activities of a company, this becomes very cumbersome, having to find each individual T-table affected by a transaction. The general ledger allows us to account these individual transactions and also informs us what T-tables need to be adjusted. The setup for the general journal is basic, but actually very informative. Each entry starts with the date of the transaction in a left-hand column. Then there is a middle area which will contain 3 lines. Listed first and written all the way to the left is the name of the account that will be debited in its T-table. Below that and indented is the name of the account to be credited in its T-table. Below that is a brief description of the transaction. In the next column go the dollar amounts for the debited account. The entry ends with the amount to be placed in the credited account. But what would these entries look like for some basic transactions? Firms need cash. Having assets in the form of inventory or long-term assets like plants or property are nice, but a firm needs cash to pay its employee wages or any bills they may have. So how can a company get cash? There are 2 basic sources from which a company can borrow money: banks or its owners. In other words, the company can take out a loan from a bank, or it can sell additional capital stock. One method for acquiring cash is to borrow it from a bank or other lending agency. Unfortunately, they want to get paid back. In fact, they usually will charge interest and require that the amount be fully repaid in a certain amount of time. These are important facts that should be included in the description for the transaction in the general journal entry. For example, suppose Polly's Plushies, a company that produces and sells stuffed animals, borrows $5,000 from the Last National Bank on September 21st, 2016 on a long-term note. What would the general entry look like? First, we list the date. Because we are increasing the amount of available cash, the account being debited is cash. The account being credited will be the liability account, notes payable. Both accounts get labeled as $5,000 since that was the amount of the loan. The last thing we need to include is a description of the transaction. This includes the terms of the loan, 15% interest on a 12-month note. Another way to borrow cash is from the owners of the company. This means selling additional stock. When entering the journal entry, we need to provide some idea of the specifics of the sale. The description should include how many shares were sold and at what price per share. As an example, suppose Polly's Plushies needs more funds than the bank loan, so they decided to release additional stock in the company. The general journal entry starts with the date of the stock released, September 28th, 2016. The account being debited is the asset cash, for a total debit amount of $20,000. The credited account is capital stock, with a matching entry of $20,000. The description shows that $20,000 amount comes from the sale of 1,000 shares of stock at $20 per share. Of course, companies need assets other than cash. They need equipment, inventory or raw materials, office supplies, an actual site for their business, and many other forms of assets. How can a business pay for those assets? They have three options. They can pay with cash. They can pay on credit, which is accounts payable, or they can take out a mortgage or other form of long-term borrowing, which is notes payable. The easiest method to acquire new assets is to pay by cash. Cash simplifies a transaction, which can occur immediately. The seller will not have to wait to receive the actual funds from the sale. For example, suppose Polly's Plushies needs to buy a new sewing machine to create their stuffed animals. Polly goes to You Dirty So-and-so sewing supply store to buy the machine and pays with cash. How would we enter that transaction into the general journal? As always, we start with the date of the transaction, September 28, 2016. The debited account will be equipment in the amount of $500. Because Polly paid with cash, the credited account will be cash for $500. The entry finishes with a description stating what was purchased, a new sewing machine, and where the purchase was made, You Dirty So-and-so sewing supply store. Often, manufacturing companies develop strong business relationships with the suppliers for their raw materials. Part of these relationships is the development of lines of credit. They allow the manufacturer to purchase needed materials with the promise to pay the amount within some short amount of time, often 30 or 90 days. Sometimes these accounts have additional provisions, like a rebate if it is paid off quickly, or a late fee. We will consider these additional provisions in a later resource. We will focus just on basic purchases on credit in this resource. Suppose after buying the sewing machine, Polly set up a line of credit at You Dirty So-and-so sewing supply store to purchase the raw materials needed to produce the stuffed animals. He then made an initial purchase of $1,500 worth of fabric and stuffing. The journal entry starts with the date of the purchase. The account debited will be raw materials in the amount of $1,500. The matching credit account will be accounts payable. The entry includes a description of what was purchased and where the purchase was made. The final types of asset purchases are for long-term assets, like production plants or land holdings, which often require more long-term payment obligations. For example, suppose Polly's Plushies successfully placed a bid to become the exclusive provider of the plush prizes for the games at the 8 Banners amusement parks. Polly realizes he needs a much more extensive production plant to meet this new demand. He buys a new plant for $2 million, obtaining a 30-year mortgage from the Last National Bank with an annual interest rate of 4%. The general journal entry for this transaction starts with the date of the purchase. The debited account is the long-term asset, plants, for the $2 million purchase price. This is matched by a credit to the liability, mortgage payable. The entry closes with a description of the particulars of the mortgage, the source, the length, and the interest rate. We introduce the general journal, which provides a method for quickly accounting all transactions. We saw the basic layout of these journals, which show the date of the transaction, the account to be debited and how much, the account to be credited and how much, and then a brief description of the transaction. We then considered the journal entries for ways companies borrow money, either from banks or from their own ownership. We also saw the journal entries for the three primary ways companies acquire other assets, with payment by cash, credit, or on long-term mortgages. But we never saw how to create the journal entries for actual sales of the company's product. How would Polly create journal entries for the actual sale of his plushies? Stay tuned for the next resource in the series.